I'm Joe Galvin, Chief Research Officer for Vistage, here to share the insights and analysis from the Q1 2025 Vistage CEO Confidence Index. Our latest quarterly survey captured sentiment from nearly 1,800 CEOs over the first 2 weeks of March 2025. On the surface, the Q1 data shows a historic drop of 22 points from Q4 as CEO confidence appears to collapse, going from 100.8 to 78.5. This has been driven by concerns about shifting tariffs, government instability, and a fear of growing inflation, which would lead to higher interest rates. Normally, a drop like this would sound the alarm bells, but when compared to Q3 2024 and the trends of prior quarters, what we see is a more modest drop of 6.6 points, taking us back to Q3 of 2023. This suggests that the Q4 responses were driven by anticipation of what the new administration could do as compared to what they are doing. All of this is underlined by the unpredictability of the new administration. The issue might be tariffs, but the problem is uncertainty about the future of the U.S. economy, the unstable tariff situation, and growing consumer unease. In all this turmoil, we look to our partner, ITR Economics, for their expert perspectives and guidance. We welcome back our friend Lauren Seidel-Baker, Senior Economist at ITR. Lauren is the co-host of the ITR By the Numbers podcast and has been interviewed on NPR Marketplace and Bloomberg. Many of our members have had and will have the opportunity to see her at Vistage Executive Summits. Welcome, Lauren. I say this every quarter, but especially in this time of uncertainty, we're grateful to have you here to help us connect CEO sentiment captured in the Vistage CEO Confidence Index with ITR's economic analysis. The Vistage CEO Confidence Index has dropped significantly in Q1 2025, wiping out the gains we saw in Q4. But in reality, it's brought us back to where we were in Q3. As a leading indicator, what does this tell you about the future of the U.S. economy?
Well, as a leading indicator, really what this does is it kind of exaggerates the point that I like to make, which is one data point never makes a trend. We're trying to zoom out here to not say that there was this little whipsaw effect, right? We saw such a high peak in Q4, dropping down in the first quarter. The general trend is still one of upward movement. So momentum from that low point of the business cycle, that is still with us. That is still in our favor. Now, maybe it means this path toward growth is not quite so linear, quite so smooth as we all might prefer. But generally, as we see the sentiment of CEOs, right, what did we think would happen in Q4? There was a lot of optimism of things like tax cuts, like less regulation, things that would be really stimulative to business. What did we see instead? Well, the downside risk of tariffs, maybe things like deportations, which could cause higher labor costs, some other typically inflationary policies were just a higher priority. So I don't think that means that CEOs are giving up on this growth cycle. There is still growth ahead. But again, it's going to bring new uncertainties, new opportunities, certainly, but also some risks that we'll have to account for.
Well, looking ahead in the short and long term, are there any changes to your forecast? I recently heard Taylor St. Germain in the March 16 ITR Trends Talk say, we'll see accelerating growth in 25 of 1.4%, followed by 1.5% in 2026. How do we separate the media headlines and noise from the economic reality of today?
The first thing to do is just look at the data. If we go back to 2024, this year we've just closed out, that was a pretty lackluster year across most segments. If you're looking at the industrial economy specifically, that's where we saw just general plateau, really flatness, and there was outright contraction in a few sectors. So seeing accelerating growth in 2025, that means this year will be better. Now, we at ITR do expect the back half of 2025 to really be where the economy picks up momentum. So in the near term, first half of this year, yes, it's growth, it's getting our feet under us, it's finding that stable base from which to launch. But I also want to balance my comments here. This launch, this accelerating growth, it's not going to be just a snap back to high growth rates. It's going to be a little bit more muted this cycle.
Can you comment on where you see inflation heading and interest rates? We know the data came out and it didn't move much, but as you look ahead, you've commented in the last few quarters that now is a time to invest. Has that changed?
Yes, I still see inflation picking up steam. Again, with the back half of this year being that growth coming back, that demand pull on pricing, that will happen for very fundamental economic reasons. We could also look at things like liquidity. There's a lot of money flowing around. That does tend to be inflationary. Government spending, that causes higher pricing. When you layer on top of that these inflationary policies like tariffs, I see that as an even higher upside risk to pricing pressures. So I want to caution companies, don't think that the inflation we see coming this year is driven entirely by tariffs. That is to say, if in tariffs we could wave a magic wand and eliminate them tomorrow, that pricing would necessarily go back to some 2% inflation rate. I fully see those fundamental factors, the more boring, the more mundane factors that we're watching, resulting in higher pricing pressures. So that's something we'll have to account for on several different levels going forward. Even though there is still some uncertainty, I would plan for higher pricing. So if this is a good buying opportunity for you, if you can take on that additional inventory, I don't think this is a bad time to do it.
So connecting dots to higher inflation, does that mean we'll see higher interest rates? You've commented the last few quarters, as we said before, that now is the time to invest.
Yes.
Help us understand that. Help us understand that.
I think interest rates are about as low as they're getting this cycle. I don't think we have, if any, more cuts left in the Federal Reserve. I don't think there are too many. The market is slowly coming along to that realization as well. So maybe we get another 25 in June. That's what the market seems to be predicting at this point. But are you really going to split hairs for 25 basis points if that means you don't have that acquisition, whether it's a business, whether it's capital equipment, whatever it is that you need today? Are you going to wait? Are you going to potentially miss that low point of the buying cycle? Are you going to miss having your people trained up on this new machine or having it installed? There's a long lead time for that. Again, by second half of 2025, most industries will feel better demand. So it's the point of getting ready now for that environment to take hold. I really wouldn't want to be waiting, trying to time the cycle. I still do think that we are in the best buying opportunity that we will see. So I hope that businesses aren't waiting and missing this opportunity. But by the end of this year, again, with inflation coming back, I don't think rate hikes will be fully off the table. I'm not saying they'll necessarily happen, but I think they'll at least be back in the conversation by year end.
Can we pivot to the labor market? February unemployment is at 4.1%. But not only do we see fewer CEOs are planning on increasing personnel in the next 12 months, but a growing portion indicate they plan to decrease headcount. Talk to us about the labor market and how you see these shifts playing out in the context of this larger economic picture you laid out.
So there are some, again, risk factors on policy to the labor market. One of the big one is these DOGE layoffs. We've seen this very easily. I think if it isn't already the largest single layoff in U.S. history, it very soon could be. That said, we have been in a challenge of limited labor availability. So these additional folks who are being freed up in these layoffs, the risk that I see is there's a skills mismatch. The jobs that they have, the skills that they have are not the most in-demand skills. So we're in a very unique position, I would say, in the labor market. I don't think this will be enough to really knock the national level averages off course. Again, the fundamentals are strong enough at this point. But the DC market, they could be hit. We could see some very isolated impacts on local labor markets. Broader than that, though, it still is something of a skills gap. There are very in-demand skills where we still just don't have enough people to do these jobs, especially as we look at the baby boomers retiring. There's a generational mismatch in some cases that younger workers haven't tended to these same career paths. Again, more broadly than that, it's a confidence issue. So this is a unique time in our labor market where we see both continued low layoffs and discharges starting to creep up, but these are not elevated levels by any stretch of the imagination. It seems like most employers to this point, they got scared by this limited labor availability. They don't want to lose their workforce and not be able to hire them back when they need them. So it's a kind of a long transition point. On the other side of things, employees don't feel very confident either. So the quit rate is still very low. We don't typically see those two data points happen at the same time.
Is there any chance we're going to return to a more normal labor market, or are we going to continue to be in these volatile cycles of hiring and then not hiring and all those things that go with it?
Normal is a loaded word, but generally I see demographics as the thing that is driving labor market trends. And we just have a shifting demographic profile. The new generation who's aging into the workforce, that Gen Z cohort, they're actually a relatively small generation. So they are not numerically sufficient to come in and replace those retiring baby boomers. We're going to have to be a little bit more productive. There are other ways to get employees, one of which would be immigration. Unfortunately, at the moment, I see that going the opposite way, where we're getting lower immigration numbers into this country. So I think technology, efficiency gains, that's what's going to have to play the lion's share of the gain, at least for the smart companies.
We've seen the headlines about AI coming into place and eliminating your need to add more headcount. Have you seen any signs that that's happening yet? And more importantly, looking ahead, when will that point in time come?
I've seen isolated cases. So some folks are being really smart about leveraging AI or automation or even just better communication, right, to their factory floor. They're finding what their existing human workforce values, and they're making these gains in a way that complements very well. More often than not, though, I don't see these productivity gains. It's certainly on the national level. It just hasn't really hit traction quite yet. I am so encouraged that there's much more we could do there, but on a broad scale, I think it has yet to take effect.
Great. Well, let's talk about one more topic, because I know it's something that all of our CEOs are thinking about, and that's pricing. Our data shows that nearly half of CEOs are planning on price increases in the next 3 months. And of those increasing prices, most are planning increases between 4 and 6%, which is slightly above the rate of inflation. What should CEOs consider when evaluating their pricing strategy?
I have to say, I am so thrilled that they are considering these price increases. I know that is not an easy conversation to have. No one on the sales side wants to go and push through higher pricing, to have that tough conversation with your customers. But I think going forward, it is going to be critical, because everything else we've talked about today, from tariffs, from the labor market, wages being higher, this is going to be a continued margin squeeze if you can't make it up on the other end. So I think this, for me, is the critical differentiator of winners and losers going forward. Do you have the competitive advantages that you need to justify that price increase? Do you have the value proposition for your customers? Why this product maybe makes better dollars and cents logic in the long term? Margin is so critical. So whether you're using the kind of cover of tariffs to do that in the short term, whether you're just watching your own inflation indicator, right? What is it for your sector, specifically for your own PPI? This is something that, with inflation having come down as much as it has, I think some folks lost sight of. That is a very, very dangerous place to be going forward.
Thank you, Lauren, for your time. Your guidance analysis will help our leaders of small and mid-sized businesses understand what to expect as they navigate the uncertainty at the end of the first quarter. I look forward to our conversation in June, which will be the mid-year update as we analyze the latest data from the Vistage CEO Confidence Index. I'm Joe Galvin, Chief Research Officer at Vistage, and I look forward to speaking to you again in June.